How's it going, investors? I'm Ari, and welcome back to the channel where we are talking strictly about dividends, dividend stocks, and dividend investing. So if you yourself are a dividend investor or just a value investor, then welcome, because this channel was specifically created for you.
Come on. The parade comes to town. Going down Broadway is a one-way street. Whichever way I...
Now, as for today's video, I want to keep it pretty simple, give you guys an update with my personal portfolio given all the rallying that's been going on, then jump to a macro market update, followed by breaking down 5 high-quality dividend stocks that you should be considering if you're shopping in the market right now amidst all of the recent volatility. Now, just before we actually dive in, I ask that you tap on that thumbs up button to help me out with the algorithm and, of course, getting the word out there. And also, guys, if you haven't already subscribed to the channel, go ahead, tap on that subscribe button. I'd certainly love for each and every one of you to be on this journey with me. Now, with all of that out of the way, let's go ahead and dive right in. All right, investors, a little portfolio update for us here. We are currently sitting at $103,588.11 within my personal brokerage account, which is not where we were months ago. I'm actually down about 5% or so, but honestly, I'm just sitting here. I'm missing the volatile days of a couple of weeks ago, given all of the buying opportunities that came about. But we are here now, so we're in a totally different economic context, and because I'm a firm believer of macros mattering, I want to just go ahead and quickly break this all down for us before we actually get into today's dividend stock picks. So as we know, the initial spark on the latest market rally was sparked when inflation came in at 7.7%. Then we had the Producers Price Index, for the PPI report, come out, and it read that wholesale prices were actually less than expected. That was yet another positive sign for all of us investors. And we also had retail sales reports come out, in which that gave way to insights on the consumers who are out there who are still spending. Now, if you are one of those consumers, guys, this is a message for you. Please stop. Let this be my direct message. Everything that you currently want can certainly wait until post-recession. With that out of the way, it is worth just touching on the labor market, which remains very robust. Now, all in all, these data sets matter and should be closely scrutinized by investors in order to best understand how the Federal Reserve is going to be playing out their next chess move to fight against inflation. You see, I believe that we won a battle when it comes to inflation coming down to 7.7%, but the war is far from over, and the Federal Reserve knows exactly that. So the big question becomes, will the Federal Reserve pivot entirely come their next FOMC meeting on January 25th, or simply just ease up on hiking rates? Now, depending on how they actually proceed, that's going to give way into really an entirely different market environment. So with macros out of the way, how about we get to breaking down some of these dividend stocks with the very first stock that I want to go ahead and break down. It's actually one of America's largest retailers, the 7th to be exact. We have Target, ticker symbol TGT. Now, I'm going to safely assume I don't need some big introduction for Target. I do want you to simply keep in mind its sheer firepower coming in with a $71.56 billion market capitalization. Now, keep that in mind because Target just missed on their earnings, while one of their biggest competitors, Walmart, actually exceeded in their earnings expectations. So what really gives here, and why am I more bullish right now on Target than Walmart? And that's a really great question. I'm happy you asked. First and foremost, we have to keep in mind that there are some major recessionary fears out there that keeps consumers away from freely spending as they normally would. However, consumers haven't necessarily stopped spending altogether. Just sifting through syndicated data, we can simply see that there's a significant change in shopping patterns, whereas consumers are now buying cheaper brands and just looking for the best possible deals. Now, there is a bit of a premium for more of a quality shopping experience with Target as well, but we aren't here to actually get into which retailer is the better store to actually have that in-store experience. We're here strictly to talk about Target as an investment. So stock has already been on its descent from inventory backups and slashing prices. And now, after their earnings miss, here we are with a share price at $155 per share. It's almost down 32% on the entire year, with their PE ratio currently sitting at 20.3, which, to be honest, I'd like to come down a tad lower, but a stock at a fair value never truly hurt anybody. And when it comes down to smart money, we can certainly see that hedge fund after hedge fund is taking up a position or adding to their positions with this beast of a retailer, investing millions into Target for that long-term recovery, which is how I see Target right now, a long-term investment. Now, once our economic conditions do swing back around and consumers find themselves more comfortable out there without the need to really penny pinch, Target is a retailer that is setting itself up for success, and a massive comeback should be on the way. Analysts see that too, with a Target share price coming up to $187.90 per share. That's nearly 21% worth of upside. And of course, until Target is back on that come up, they're going to be shelling out that dividend of theirs, coming in at a dividend yield of 2.18%. Our next dividend stock is one that I'm actually thrilled to be talking about, given I just discovered it and rather recently found out just how much of a role it's been playing in my everyday life. We have Masco, ticker symbol MAS, which is an American manufacturer of a wide variety of products for home improvement and new home construction markets. Now, they manufacture anything from bare paints, primers, and wood finishes to faucets, bathroom glass, and endless pools, comprising of over 20 companies with 34 brands in total, operating on a global scale in over 20 countries worldwide. Now, Masco is truly an under-the-radar type of investment, in my opinion, and has been silently leading their industry since 1929, but we're about to blow up that spotlight of theirs, coming in with an $11.35 billion market capitalization and a market valuation here. They're currently down on the year by 26%, trading for just $50.34 per share, which may spook some of you if you don't understand this economic backdrop. But in understanding it and those recessionary concerns everybody has on their mind, mortgage rates that are climbing, and of course home sales that have declined, aka not good for business when it comes to Masco, well, you can start to paint that picture. However, investors, the time is ripe with its PE ratio at 13.9, and while some patience is gonna be required when it comes to an economic turnaround and a solid return on this investment, in my opinion, Masco could very well just deliver through on a great ROI, which analysts are forecasting, and Masco is going to come back up to $53.55 per share. That's 6% worth of upside, but an even higher target share price here of $64 per share. Now, an investment into Masco is pretty similar to a Stanley Black & Decker type of investment, ultimately meaning that we shouldn't exactly expect an instant winning lottery ticket, but with that patience, in my experience, well, patience just always pays off. Now, of course, we also have their dividend coming in with a dividend yield at 2.16%. Next up, we're going to be breaking down C.H. Robinson, that's ticker symbol CHRW, which is another newer mention on this channel as a dividend stock opportunity, yet it's one heck of a lucrative investment within the logistics space. Now, C.H. Robinson has been in business since 1905 and has ultimately become a very powerful Fortune 200 provider of transportation services, and not too long ago was ranked 5th among third-party logistics providers within the United States. In terms of their market capitalization, C.H. Robinson has amassed a $10.92 billion market cap. Their share price right now is down on the year by roughly 12%, trading for $92.80 per share. Now, their PE ratio is coming in at just 11.9, which, all things considered, with consumer demand down and logistics companies across the board feeling the pinch, creates a C.H. Robinson investment opportunity, in my opinion, with hedge funds already seeing the opportunity to investing into the company and building up a position. Now, in the meantime, there are expectations from analysts that C.H. Robinson is going to jump by over 6% to a target share price here of $99.22 per share, and then some thereafter to a higher target share price of $120 forecasted. And until it does just that, C.H. Robinson will likely just continue to shell out their dividend to shareholders, coming in with their 2.25% dividend yield. As for our fourth dividend stock on the day, let's go ahead and talk about Atmos Energy, ticker symbol ATO. Now, it's a utility sector investment, meaning there's more reliability and less volatility when it comes to investing into Atmos. Not only is Atmos one of the largest natural gas distributors in the United States, but this company has established itself quite well as a leader within the industry since 1906, coming to serve roughly 3 million gas distribution customers in over 1,400 communities across the United States, all of which has allowed Atmos to amass a $15.82 billion market capitalization. Now, as mentioned, the utility sector investment is often safer and, of course, more reliable during uncertain times, which is why Atmos Energy is not down on the year, but it's still presenting itself as a ripe opportunity at $112 per share with that PE ratio under 20 at 19.9. We can also see that certainly the masses are beginning to ultimately come around to the utility sector and investing into investments like Atmos Energy, given our economic backdrop and the fears of what's to come over the next 6 to 12 months, which is why we're seeing a lot of investors just loading up on shares worth of Atmos, padding up their portfolios. But most importantly here, let's keep our eyes on the prize when it comes to analyst forecasts, and we can see that there's nearly 10% worth of upside when it comes to Atmos Energy, with a target share price coming up to $123.40 per share. And moreover, because we are all here for their dividend, Atmos is currently shelling out a dividend, coming in at a dividend yield of 2.44%. And last but not least, a dividend stock opportunity that has been and remains almost too good to be true. We have T. Rowe Price, ticker symbol TROW, which has been spoken about quite often on my channel. But I mean, seriously, how could it not be? We just can't pass this opportunity up. I mean, we're talking about a global investment firm that has been in business since 1937. It's only come to make quite a name for itself, offering funds, account management, and retirement planning for the everyday individual to top-tier institutions, allowing for their market capitalization to reach $27.68 billion. Now, with $1.2 trillion in assets, most of which are tied to the stock market, more specifically the NASDAQ, you better believe that T. Rowe Price has been taking quite a beating over the last couple of years, plummeting by over 33% just this year alone, with its share price at $123 per share. However, keeping in mind that our economic recovery and a bull market would send T. Rowe Price right back up, we have a beautiful opportunity to get our hands on a great stock, especially with their PE ratio right now at just 14.5. Now, it is certainly notable that just the other week, with all the positive news that came out, it flooded the market, from inflation coming down to the PPI report, T. Rowe Price skyrocketed from $105 per share all the way up to past $130 per share. Now, just imagine a full-blown market recovery, which is why hedge funds are throwing money into T. Rowe Price, recently increasing holdings with over 562,000 shares bought last quarter alone. That equates to millions upon millions of dollars being poured into this financial industry leader. As for analysts, higher share price here of $123 per share. Either which way here, T. Rowe Price is likely just going to be shelling out that dividend of theirs, coming in at a dividend yield of 3.73%. Now, investors, that's it from Target to Masco, C.H. Robinson to Atmos Energy and T. Rowe Price, my 5 dividend stocks for the week ahead of us here, to at bare minimum add to our watch lists and proceed with an investment only if it makes sense for your portfolio. Now, I want to go ahead and just remind you all that I am not a financial advisor, so be sure to do all your due diligence following my videos. But regardless, I am eager to know your thoughts on any or all 5 of these dividend stocks, so be sure to leave a comment down below. And before we actually close out, if you've learned something new or you've taken something away from today's video, please do me a massive favor here in tapping on that thumbs up button. Now, on the other hand, if you didn't learn anything new or you didn't take anything away from today's video, but you enjoyed, do me a favor in tapping on that thumbs up button. It all helps me out in growing this channel. And moreover, guys, if you haven't already subscribed, go ahead. You still have that opportunity to do so right now by tapping on that subscribe button. And until that very next video, guys, I will see you all there.